Hello, everyone. I'm Yazan Ibrahim, or as some of you might know me, Yazan Abu Ghosh. Today, we're going to dive into a fascinating and essential topic, Fraud Examiners Section 1, Financial Transactions and Fraud Schemes. Welcome today's deep dive into the world of accounting, where we'll explore the fundamental concepts that underpin financial institution, fraud embezzlement schemes, loan fraud, real estate fraud, new account fraud schemes, money transfer, wire, fraud schemes, automated teller machine, ATM, fraud, account takeover, advance fee fraud, letter of credit fraud, inside outside frauds, prevention, suspicious transaction reports, the Basel Committee on Banking Supervision. Whether you're an aspiring fraud investigator, a business owner, or simply curious about how organizations manage their finances, or if you are auditor, this journey will shed light on the often complex systems that drive decision making. Picture this: a bustling financial district where the engines of commerce, the banks, credit unions, and savings institutions operate with precision. Yet beneath their polished surface, hidden mechanisms of malfeasance often churn. This video will unravel the multifaceted web of financial institution fraud, exploring its many threads, from embezzlement schemes to intricate loan fraud operations. We begin our story with how financial institutions, which serve as the bedrock of economic stability, define their roles. These establishments perform various tasks, from safeguarding deposits to extending credit and facilitating transactions domestically and internationally. However, this very diversification creates opportunities for fraudsters, both inside and outside these institutions. The anatomy of embezzlement, a breach of trust. Imagine an entrusted guardian turning into a betrayer. Embezzlement begins when someone in a position of trust wrongfully takes what isn't theirs, converting the property or funds for personal use. Within financial institutions, this can take many forms, often cloaked under sophisticated bookkeeping disguises. 1. False accounting entries. Think of an employee with access to the institution's ledgers. They might create a deceptive debit entry, offset it with seemingly legitimate credits, and siphon off funds into their personal account, masking their actions behind layers of numbers. This deception is often the financial equivalent of patching one leak while creating another, with increasingly complex schemes required to hide initial thefts. 2. Suspense account schemes. Consider suspense accounts as holding zones for transactions awaiting classification, a necessary operation in any organization. In fraudulent hands, these accounts can become black holes where funds vanish, reappearing in personal accounts or as unauthorized disbursements. Could there be a more perfect haven for financial sleight of hand? 3. Unauthorized withdrawals. These are small yet audacious strikes, often targeting inactive customer accounts. Imagine an employee quietly transferring funds, banking on the assumption that the owners will not notice, or that they will flee before detection. 4. Moving dormant funds. Dormant accounts resemble buried treasure, hidden yet holding immense value. Fraudsters exploit these by reviving them with counterfeit transactions, transferring funds into accounts they control seamlessly. The trail of detection, signs of misconduct. An essential part of this unfolding story is how fraud is uncovered. Like finding footprints in the sand, investigators look for red flags archived within financial documents. Examples include missing receipts, altered source documents, or payees suspiciously aligned with employee information. For larger embezzlements, financial statement analysis can uncover abnormalities such as surges in reconciling items or unbalanced master accounts. Loan fraud, the high-stakes gamble. Loan fraud represents a particularly high-risk domain in financial crime, often involving astronomical sums and meticulous planning. 1. Loans to non-existent borrowers. Imagine fictitious borrowers conjured up on paper with phony financial statements presented to unsuspecting loan officers. The funds flow, but instead of aiding a business or family, they vanish into fraudsters' accounts. 2. Sham loans and kickbacks. Think of a loan officer colluding with accomplices, approving loans in exchange for a cut of the proceeds. Once these loans default, they may be conveniently written off as bad debts. 3. Double pledging collateral. This scheme could be visualized as a single piece of collateral being promised to multiple lenders, intentionally leaving them entangled in a web of competing claims. Fraudsters also manipulate credit information to bypass regular checks, engaging in practices such as credit data blocking, where they falsely report loans as identity theft cases, temporarily erasing negative credit histories to obtain more loans. Throughout this video, we'll dive even deeper, exploring skimming irregular receivables, swapping bad loans in schemes known as daisy chains, and unraveling fraudulent structures concealed amid the legitimate operations of financial institutions. We'll wind down by discussing measures to detect, prevent, and combat these fraudulent practices, equipping viewers with knowledge to understand and protect against them. The final notes will leave the audience considering the broader implications of these crimes. How do they impact trust in financial systems? What safeguards can institutions implement to remain resilient yet versatile? Real estate has long been seen as a cornerstone of wealth and stability, a field where dreams of home ownership come alive and fortunes are made. But beneath the glossy advertisements of idyllic homes and lucrative investments lies a shadowy side: the billion-dollar world of real estate fraud. Today, we're going on a deep dive into this complex and hidden realm, exploring how real estate fraud works, the schemes that fuel it, and how experts strive to expose the cracks in its seemingly solid foundation. Stay with us, and by the end of this journey, you'll see the industry not just as a place for property transactions, but as a theater where integrity must face off against deception. Let's start with the broad picture. What is real estate fraud? At its core, it's a false representation or misleading information, coupled with an intent to deceive, used in connection with a real estate transaction. But this definition, while simple, conceals a multitude of schemes, some so intricate that even seasoned professionals can fall prey to them. One of the major gateways to real estate fraud is through loans. It's worth considering why this is so. Real estate transactions often involve massive sums of money, sums that individuals or even corporations rarely possess outright. This creates a reliance on financing through loan, which brings in key players like appraisers, lenders, and auditors. However, this setting also provides fertile ground for fraudsters, people who manipulate the system either to inflate their wealth or to cover their financial missteps. Loan falsifications exemplify this issue. Fraudsters here rely on forged or altered documents to create the illusion of financial capability. Imagine a fake bank statement showing thousands of dollars more than its owner actually has, or a forged letter of employment claiming someone works at a job that doesn't exist. These documents act like masks, hiding the truth while securing loans that might never be repaid. But the red flags for such activity are there, waiting to be noticed. A loan applicant purchasing investment property who doesn't own a primary residence, a handwritten loan application riddled with inconsistencies, or someone whose commute time from work to their new home stretches belief. These are just some of the signs that fraud examiners are trained to detect. Let's now turn our attention to appraisals, one of the cornerstones of real estate transactions. An appraisal is meant to give an impartial estimate of a property's value, ensuring fairness for buyers, sellers, and lenders. In theory, it's a protective mechanism. But in fraudulent schemes, appraisals become tools of deception. Fraud can corrupt this process in numerous ways, from influencing appraisers with promises of future business, to manipulating critical assumptions like vacancy rates or expected rental income. If appraisals are the maps of the real estate world, fraudulent ones lead to dead ends or worse, financial whirlpools. For example, in one case, appraisers might knowingly use invalid comparables, properties that are completely dissimilar to the one being evaluated, just to justify an inflated price. Other times, market data is outright fabricated, presenting a false picture of the neighborhood or market trends. Such tactics are not just deceptive, but dangerous, creating a ripple effect of bad loans and bankruptcies. But perhaps the most vivid fraud schemes emerge during times of economic downturns. Let's consider the builder bailout scheme. Picture a struggling real estate market where builders are left with unsold inventory piling up like unsolvable puzzles. Crushed under mounting debts, they might use fraudulent practices to unload properties, such as inflating their values or masking hidden seller financing. These tactics let them pay off debts, though at the potential cost of destabilizing the wider market. The condo conversion market is another prime example, where developers scrambling to convert apartments into condos can resort to similar deception when the market isn't on their side. Now, some of you might be wondering, what safeguards are in place? How do professionals within the industry identify fraud before it takes root? The key lies in vigilance, reviewing every detail of appraisals and loan documents. Are all cited comparables realistic and accurate? Does the demand in the properties area support the transaction? Fraud examiners notice when an appraiser's credentials are dubious, fees are unusually high, or when documents contradict underlying market trends. These red flags are the breadcrumbs that light the path toward uncovering deception. Finally, let's pull back and look at the broader circle of consequences. The 2008 financial crash is a painful reminder of what happens when fraud runs rampant. That era's subprime mortgage crisis revealed how unchecked lending practices and outright fraud led to devastating economic impacts. Even today, post-recession programs to revive the housing market create opportunities for new fraud schemes to take root, schemes that adapt and evolve alongside economic policy changes. So, what's the takeaway? Fraud may be an enduring specter in the real estate industry, but awareness can be the armor that protects us from it. By understanding the patterns of deception, keeping an eye out for the red flags, and demanding transparency at every step, we can strive towards a future where integrity is not the exception, but the rule in real estate transactions. Thank you for joining me on this eye-opening journey into the hidden world of real estate fraud. Whether you're a professional in the field or just someone looking to buy their first home, know that knowledge is your best defense. When people think of fraud in the financial world, it might appear as an abstract and distant issue, but its impact ripples through economies, businesses, and lives. Let's delve deep into the web of schemes and safeguards that shape the financial landscape, unraveling stories of deception and the measures crafted to counter them. This narrative is not just about understanding how fraud occurs, but about grasping the ingenuity behind schemes and the resilience of those who stand against them. The web of brokered loans, a tale of deception. Imagine a trusted individual presenting a lucrative opportunity, a package of residential loans ready for investment, or a hefty single commercial loan with promises of high returns. This is the world of brokered loans. But behind the alluring facade of profit lies a cunning trap. The fraudster, masked as a broker, might sell these loan packages, collect exorbitant fees, and then vanish without a trace. What the purchaser is left with is a cold package of liability, forced to recover funds through borrowers or collateral, as recourse to the broker is non-existent. Now consider a twist: loan participation. Here, multiple institutions share interest in a single loan. While the lead bank often manages underwriting, other participating institutions might overlook critical due diligence. This negligence can open the doors to fraudulent schemes, where documentation falls apart under scrutiny, revealing a financial facade instead of a genuine asset. As the web of fraudulent schemes expands, institutions worldwide have devised layers of countermeasures to detect and deter wrongdoing. Let's journey into this realm of protection, where thoughtful design and strict protocols seek to uphold financial integrity. Layers of defense, loan origination to closing. In financial institutions, every touchpoint of a loan's life cycle, from origination to underwriting, closing, disbursement, and servicing, offers an opportunity for either adherence or abuse. By isolating these operations, institutions minimize the risk of internal fraud. Imagine a robust chain where every link undergoes independent review, creating a multi-layered shield against both insider fraud and faulty partnerships. When loans involve higher than usual sums, committees step in. These governing bodies scrutinize the minutiae of large transactions, meticulously analyzing unusual patterns and deterring potential fraudsters who prefer ambiguity. Beyond loans, mindful reviews, and observant employees. The integrity of financial institutions doesn't rest solely on process. Sometimes, the sharp eye of a colleague catches the subtle signs of deceit. Trained employees are the unsung heroes of fraud prevention, detecting inconsistencies in documentation, questioning irregular behavior, and maintaining a collective vigilance that larger systems might miss. Training programs and standardized procedures equip these individuals to identify and neutralize threats before they escalate. For example, if one teller verifies deposits only after a cautionary conversation with the depositor, they've already reduced the likelihood of fraud. Meanwhile, independent audits ensure that no fraudulent loan can slip through unnoticed. These routine checks bring a fresh perspective, effectively revealing phantom loans or manipulative processes that might otherwise remain buried under layers of seemingly standard procedures. Global trust through supervision, the Basel Committee. From the complexities of fraud prevention, we turn the lens to an international stage, where bodies like the Basel Committee on Banking Supervision emerge to unite nations under a common banner of financial oversight. Founded in 1974, this committee fosters global cooperation, setting the standard for effective supervision. With principles emphasizing that no banking entity escapes scrutiny, its guidelines carve a pathway for harmonized approaches to supervision while respecting the individuality of national systems. In 1988, the Basel Capital Accord introduced a revolutionary system, a credit risk framework requiring minimum capital reserves to protect against unforeseen losses. This framework, refined in subsequent years, underscores the enduring goal of stability in banking practices. Through its pillars of minimum capital, supervisory review, and market discipline, the Basel Committee lays a sturdy foundation for resilience in a volatile financial ecosystem. The front lines, suspicious activity reports. At the heart of fraud detection lies a tiny yet mighty tool, the Suspicious Transaction Report, STR. By reporting unusual behavior, financial institutions provide law enforcement with the leads they need to unravel criminal activities, particularly those tied to money laundering or terrorism financing. Such measures, guided by international frameworks like the Financial Action Task Force (FATF), represent the global commitment toward transparency and accountability. Fraud in the financial world is not merely an obstacle. It is a challenge that tests both the vulnerabilities and the ingenuity of institutions. The fight against deception requires constant vigilance, education, cooperation, and innovation. And as financial systems evolve, so too must the defenses that guard them. While the stories of fraudsters may be dramatic, the tireless efforts of those who detect, deter, and dismantle schemes are a testament to our collective resilience. Thank you for watching, and as always, continue learning. Stay curious, and we'll see you next video.